Looking to take your financial knowledge to the next level? You're in the right place. Welcome to Ask Ralph, offering accounting, technical, and financial advice. Whether you're looking to save taxes or improve your business, he's got you covered. Here's your host of Ask Ralph, Ralph Eastup Jr.
Hello and welcome back to the Ask Ralph Show. I'm sort of in this mode of year-end tax planning now, and if you've been listening to the show, we've done some things on, getting yourself financially organized for year-end. But now I want to take a few minutes and talk about 7 year-end tax planning strategies for small business owners. Now, these are going to affect small business people. So if you're not a small business person, enjoy this conversation. If you are, pay particular attention. So what are the 7 year-end tax planning strategies for small business owners? The number one is claim 100% bonus depreciation for certain asset additions. These are the things I'm talking to my clients about right now. Thanks to the Tax Cuts and Jobs Act, 100% first-year bonus depreciation is available for qualified new and used property that is acquired and placed in service in calendar year 2018. That means that your business might be able to write off the entire cost of some or all of your 2018 asset additions on this year's return. So if you're considering adding some new equipment or adding some of those type of assets, this may be a great time to do it. Now, call somebody like myself or your tax advisor or accountant and make sure that this 100% depreciation works with the type of asset you're talking about purchasing. But generally, think about it in these terms. If you're a subchapter S corporation and, that's going to be income that passes through to your personal income tax return. Let's say you're in the 30% tax bracket. Well, by buying something now, you're effectively saving 30 cents on the dollar. So I tell clients this all the time. Let's say there's this machine that you want to buy that would improve your business, and let's say it's $10,000. Well, effectively, if you buy that, it's only going to cost you 70% of that because of the tax deduction. So this is something that can really help you out. Number two, claim 100% bonus depreciation for heavy SUVs, pickups, or vans. What do I mean by that? Now, if you have a heavy SUV, pickup, and vans treated for tax purposes as transportation equipment, that means they qualify for 100% bonus depreciation. Well, what does it mean when they say heavy SUV? Well, they've defined that. 100% bonus depreciation is available only when the SUV, pickup, or van has a manufacturer's gross weight rating, this is the GVWR, above 6,000 pounds. Now, the easiest way to verify that is you go take a look at the manufacturer's label, which is usually found on the inside edge of the front driver's side door where the hinges meet the frames. So if you're considering buying something for your business at the end of the year and you've got a decision to make, whether you're going to buy, the standard SUV or you're going to go with the heavy SUV, because of this deduction, you might want to consider going with the heavier one. Number three, cash in on more generous Section 179 deductions. What are we talking about here? Well, the Tax Cut and Jobs Act increased the maximum Section 179 deduction to a whopping $1 million in 2018. Before, it was $510,000 in 2017. So they've doubled that. That's a lot of money. Now, that may not affect most business people or most small business people, but it does give you the opportunity to basically wipe out all of your taxable income if you're buying assets this year. Now, there have been a few changes to this, which I'll bring out, and that is property use for lodging. In the past, you weren't able to use Section 179 deductions for personal property used in connection with furnishing and lodging. Now, if you own a hotel or a rental property, something like this would affect you, but now you can. They've also changed the Section 179 for real property expenditures. What am I talking about here? Qualifying real property means any improvement to an interior portion of a non-residential building that is placed in service after the date the building is first placed in service. So what are we talking about here? So if you're making modifications to the inside of your building, any improvements to an interior portion of the non-residential building is placed in service after the date this building is first placed in service, you can take a Section 179 deduction for that. And in addition to that, they've now expanded real property to include expenditures for roofs, HVAC equipment, fire protection and alarm system, and security system. So in the past, we would have had to have capitalized those things. So a client would come in and say, hey, Ralph, I've got this business and we have our own building and I had to put a new HVAC system in. I wasn't able to write off the total cost of that HVAC system in the past. I'd have to depreciate that over its useful life. But now with this change, I can write off that as a Section 179 deduction up to that maximum of $1 million. So that is really a huge thing now. So there's some planning going to that. Now, number 4, time, business, income, and expense deductions for tax savings. What am I talking about here? If you know that next year's individual federal income tax rates brackets will be the same as this year's, of course, there's always a modest bump in inflation. The traditional strategy of deferring income in the next year while accelerating deductible expenditures into this year makes sense if you expect to be in the same or lower tax bracket. So we're playing a little game here between years. And these are the things that I'm telling clients right now. If you expect your tax burden to be about the same this year as it is next year, pay some expenses ahead. We'll talk about that in a few seconds here. Wait on some income. Now, on the other hand, if you're expecting your income to go up, let's say you already know you've got a big project that's going to be, launching in 2019. Well, in that case, you may not want to push, those expenses into the new year. You want to push those expenses into the new year and not take them this year because you're expecting that inflow of income in the next year. So how do you defer taxable income? Number 5, most small businesses are allowed to use cash method accounting for tax purposes. Cash method basically means that you recognize the income when you actually receive the cash. So assuming that your business is eligible, it allows you to micromanage your 2018 and 2019 business taxable income in order to minimize taxes over the 2-year period. How do you do that? Well, you can charge recurring expenses you would normally pay every year early on your credit card. So let's say we're getting to the end of the year in December and you say, you know what, I'm going to be buying these things anyway. Let me go ahead and buy those now, put them on the credit card. So you can claim the 2018 deduction even though the credit card bills won't actually be paid until 2019 because you've incurred that liability or you've incurred that debt. So you can max out those credit cards to grab those expenses. Now, if you don't want to use a credit card, you can pay expenses with checks and mail them a few days before year end. The tax rules say you can deduct the expenses in the year you mail the checks, even though they won't be cashed or deposited into early next year. Be careful with this. For big ticket expenses, consider sending checks via registered or certified mail so you can prove they were mailed this year. Before you prepay, you might want to before year end, you might want to prepay some expenses. Consider prepaying your rent. Consider prepaying some of your property insurance coverage. And the same thing goes with income. If you don't want to get that income this year, maybe you decide to invoice, right at the end of the year and you don't wait till the end of the year to make that thing. And of course, the final one is establish a tax favored retirement plan. And it may be too late to do this, but you can consider setting up a SEP IRA or some sort of 401k plan for your business so that you can contribute as well as do some matching. Now, if you wanted to set up a simple IRA, you had till October 1st to do that, so it's too late. But you can definitely set up a SEP IRA, and you can fund that up through the time that the taxes are due. So you've got some time to make those plans, but these are all, year-end moves that you should be thinking about right now.
You've been listening to Ask Ralph, brought to you by Saggio Accounting Plus. Please subscribe to and rate our podcast on Apple Podcasts or wherever you get your podcasts, and leave us a rating and review. Our podcast is produced by Carolyn Peters. Thank you for listening, and be sure to like us on Facebook and follow us on Twitter at Ask Ralph Media. You can also hear me each week on 1450 WILM and on 1410 WDOV in Delaware and on the iHeartRadio app. Submit your questions or ideas for future shows by sending an email to AskRalph@AskRalph.com.
The information contained in this episode of Ask Ralph is based on data available as of the date of its release. Saggio Accounting Plus and Ask Ralph Media Inc. is under no obligation to update this content if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances, and any information provided is not to be considered as financial, tax, or legal advice. Please consult your tax advisor or attorney before acting on any material covered.